So producer prices came out yesterday morning and Wall Street reacted fairly positive to the news there because it came in a little bit underneath expectations. The expectations for final demand, both goods and services aggregately, was supposed to come out at about a 1% increase. Instead, we got 0.8, so Wall Street was extremely ecstatic that because final demand prices were rising on an annualized basis of just underneath 10%, that somehow amounts to be a whole loads better than a 12% annualized rate. Hooray. However, looking at the aggregate numbers sort of betrays where the drive in price is going on, because when we take a look at the goods inflation, that's the inflation for foods, energy, and hard products there that we're actually buying that's not providing some type of service such as entertainment or anything like that. Those goods drove up by 2.4%. So, the essential things that we need are getting more expensive, but they were offset by a flattening in the demand for services. And that shouldn't come as too much of a surprise in those services because it falls really in this other category. And again, in that other category is in more leisurely activities there. Transportation and warehousing, though, which is, the transportation and movement of these goods and goods to us to get to the consumer through the retail sector, that jumped by 1.9%. So, when we're taking a look at what matters in the producer price index, this is not a good report, and it's showing a very high drive up in price. We can see this on the front end when we take a look at the producer price index for commodities. They've jumped up by over 3%. Commodity prices have skyrocketed. Of course, this was taking place some of this had to do with the invasion of Ukraine by Russia, which drove up the prices of certain metals, minerals, wheats, and oil. And some of that has abated now in the middle of March. Nevertheless, we're seeing a continuation of the escalation of price increases month over month from January, and this is the highest month over month increase since May 2021. When we take a look at the percentage change from a year ago, we see that producer prices for commodities are staying high, and the annual rate is remaining at 20% inflation, which is more indicative that and supportive that the consumer price inflation index is not going to fall much below, say, 7% year-over-year inflation. As a matter of fact, by my understanding and my own guessing on this, we're probably not going to see anything below 8% year-over-year before the end of this year. I could be wrong on that, but that's my own understanding. Intermediate demand is showing a little bit of an abatement, so the price increases are coming up in the earlier end of the front. We got a 3% jump, but in the intermediate section with intermediate goods produced, it was only a 1.4% jump, but that was a stark increase from where we were in the lows on December, and it seems to be more reflective of what we were seeing earlier on in 2021. This bump up in the intermediate goods right here is scarily reminiscent of the money supply jumping of M2. So I'm going to bring that up right quick and take a look at M2 right quick. But we saw that M2's year over year increase skyrocketed in 2020 and reached growth rates as high as about 25 to 30%. And see, here it is right here, and it goes all the way up to early 2021. It peaks out in February of 2021 at 28%, and then lo and behold, we see the producer price index numbers start spiking at that time. And now that we're seeing the drop here, we're seeing the drop in those monthly year-over-year changes in the M2. Then we're seeing the change here in the monthly change on the producer price index for intermediate goods. So it's very interesting to note there. And that's probably indicative that because we're still seeing elevated levels of money supply growth, even though they're calming down and the Fed is beginning to tighten on its monetary policy, relatively speaking, we're probably still going to see, based off of some geopolitical forces and the amount of money still coming into the system, we're probably going to see some elevated intermediate goods prices, which then is going to feed itself into final demand. So while final demand was 0.8%, and that's down from 1.2% in January. We're still on this upward trend, and indeed, final demand year over year is still hanging around 10% year over year inflation, and that seems to be pushing up and will push up the consumer price index as months go by. So while I'm thinking that we're not going to see anything below the CPI annual inflation rate of 8%, it's very possible we could see the CPI push up to 9-10% before this year's over, with pricing pressures despite relatively tighter monetary policy. Doesn't necessarily mean that will happen. There are some efforts to sort of mitigate and possibly argue that in the latter half of 2022 we might see some calming down of the inflation rates, but certainly the sanctions that have been placed on Russia, the war of Ukraine and Russia has disrupted the supply of commodities, and more than likely as summer comes around, we're going to see a spike up in those prices very highly. We're getting a little bit of a break in oil right now because we're entering the springtime, even though they pushed up relatively when Russia invaded Ukraine, but there's no telling to the systemic damage to the oil supply and goods available for us as the months press on. And as demand for energy increases into the summer months, we should be seeing commodities press up relatively as well. I hope not, but I hope that's not the case, and I hope I'm wrong on that, but my guess is that we will. So when we take a look at some of the selected goods here for the final demand, let's see where the push-ups are taken into place. So as I've said before, they're pushing up in the demand for goods, and it seems to be primarily concentrated in food. Food here has jumped. They've jumped at 1.9%. The other one is obviously energy. So we're going to see this spill over into the CPI next month. Energy jumped by a whopping 8%. So and this is really being driven by gasoline, as well as home heating oil energy, and then diesel fuel. So those three categories right there are really pushing up energy prices right now, and we will probably see that spill over into the CPI next month. Even though oil seems to have retreated recently, I'm not sure if that's really going to hold or not. I hope it does, and I hope it retreats even further, but my guess is as not, absent of some type of stabilization going on inside of the Russia-Ukrainian situation in the East right there with the war that's happening. As I said before, final demand services were flat this month, 0%, after jumping by a whopping 1% last month. So, but it's not evenly distributed. So while there are certain things such as machinery and equipment that are pushing up very strong, especially when it comes to vehicles. So if we take a look at the vehicle prices and the components that go into vehicles, this is 1.3%. That's an increase right there. If we take a look at, say, automotive parts, including tires, that was a 0.6 jump right there. And let's see, what else can we see here? There's your transportation and warehousing. There's the 1.9% jump right there. There's your truck transportation and freighting cost, a 2% jump. And airline services are jumping 3% as the pandemic is waning, and so now the demand for flights are picking up very quickly, and that's pushing up those prices. But they're also offsetting in drops right there. So there's been a drop in software costs. There's been a drop in advertising sales. That's interesting right there. I'm not sure what's causing that. Interesting part is that there's a drop in consumer loans. Didn't even know that was a component of final demand. Not really sure where that one's coming from with these credit services and banking that's going on. I guess they're trying to take a measure of banking services and things. This is the same that's true with portfolio management and life insurance. Not really sure of how that goes into the producer price index, but hey, I guess they're trying to measure the banking industry as far as a service that is constructed for people as well. So looking at the model and how all of this factors in, this 0.8% increase is more than likely going to feed into a 0.8% increase in the CPI. So right now, the producer price index has been averaging at about a 0.8% increase. I have modified the CPI to reflect this because I have noticed that when I take the 3-month average of the producer price index monthly changes and put that into the CPI forecast, I've got an even more accurate forecast number of producing a estimate of what the CPI will turn out to be, plus or minus 0.5%. So now I am over a 90% accurate interval here, and it's really close to 92% accurate right here. So it's just over an 8% error in this model here to predict next month's CPI. So next month's CPI is looking like it's going to be 0.8%, and then plus or minus 0.5 at 0.3 to 1.3. My guess is that we'll probably hit right on the dot at that 0.8%. I think that's really going to be the sweet spot here, because when we take a look at the CPI monthly changes, when we take a look at these monthly changes that have been going on, for the last several months, they have been hovering around that 0.8%. Because when we take a look at this 0.8%, it was actually 0.9. We actually got 0.7 in November. It was 0.8 in December, 0.7 in January, and then it was 0.6 in December. Sorry. 0.7 in January, and now it's 0.8 in February. So my guess is that we'll probably see a 0.8% increase in March or somewhere around there. Could be a little bit higher if I were to guess, as like I've said before and observed, the producer price, the CPI as a percentage of the producer price index for final demand is at all-time lows. There seems to be a dragging lag. I've discussed this before, but I think what's weighing down the CPI front is definitely the housing prices, as they have been spiking, and we're just not seeing that in the owner's equivalent rent and the rental prices yet. I do think that's still going to come along, though how much is the CPI actually going to reflect reality on that? Who knows? When we take a look at what's going on for the annual pace, we're really looking at a spike by the end of the year based off of, the trend that has been pushing up here in the CPI. We're seeing a stabilized high inflation rate, and it looks like that based off my estimate, forecast, really a projection, we're going to be pushing 10% inflation by the end of this year, very possible, unless if we start seeing a change in the fundamentals, and we'll start noticing that in a fall in commodity prices, which hopefully will push down intermediate goods in the producer price index, and that'll facilitate over into final demand. And that's really all that I've got for this forecast. I am going to produce another video tomorrow that's going to talk about the Fed hikes and give an update about that and my own thoughts, as well as show you a couple charts and my own analysis of what that means for our economy. But based off of these pricing pressures, we're really looking at the Fed being behind the curve, as inflation rate is looking to threaten to be pushing over 8% by March, and more than likely, as time goes on, it will be pushing up to 9 or 10%. The Fed is just having interest rates are way too low. There's too much money sloshing around in the system right now. Until we start seeing a calming in the money supply numbers, a huge drop under 10% money supply year-over-year growth, we're just not going to see that drop in prices just yet. So just keep on the lookout for that. And of course, I'll give you updates on my thoughts. Of course, I have produced my own formulation off of this based off of the money supply and how that relates to GDP. But it has to be stressed here that this curve notation here is really a back-of-the-hand calculation. It's really taken into account that I know what the GDP numbers are going to be, which I don't, and factoring in the CPI and how that compares to the money supply. So it's going to be very difficult to give a real forecast on long-term projections for the CPI as it comes out. But basically, this graph and this chart analysis that I'm showing here is that when you control for the change in quantity goods, there is a direct relationship between money supply and consumer prices. Now, people with common sense obviously know this, but many people inside of government, and including very intelligent economists, are absolutely fooled and baffled and think that there's all these different factors that play into price inflation, and it's not. It's literally how much are we producing and how much money is there in the system. If we produce less, the price goes up. If more money enters the system, prices go up. What's going on? More money is entering the system at a greater rate than what we are seeing in the increase in quantity goods. So naturally speaking, we're seeing prices press up from that. And that's what this basic chart is showing here, is stripping out that variation and showing a very calm, pretty, well-rounded correlation between the increase in inflation and the increase in money once you trade out the quantity of goods. Once again, guys, I thank you for watching this video. If you like the content that I provide, make sure you click that like button. Subscribe to my channel if you haven't already. Click that notification bell so you're always notified whenever I do upload a video. Stay tuned for my update on the words from the Fed when they came out this afternoon. I paid attention to them, made a few notes on that, and I've got some interesting things to talk about what that means. They definitely took me by surprise a little bit, but they're still going to be well behind the curve when it comes to dealing with price inflation. Once again, guys, I thank you for watching this video, and I'll talk to you next time.